So, you're thinking about buying a house. That's awesome, super exciting stuff. But let's be real. The second you start hearing words like principal, interest, PIT, your head starts to spin, right? It can feel like a lot. But don't you worry. We're going to break it all down piece by piece. I mean, this is the question, isn't it? What's it really going to cost me every month? Because that's the number that matters. That's what decides what you can actually afford. So that's what we're going to do. We're going to walk through exactly how to find that true all-in number so you can go into this thing feeling totally confident. Okay, so first things first. We got to start with the basics, lay a little groundwork. Let's just make sure we're all clear on what a mortgage even is. At its core, a mortgage is just a loan, but it's a special kind of loan specifically for buying a house or property. I mean, let's face it, most of us don't have a few $100,000 just sitting in the bank, right? So a bank lends you the cash, and you promise to pay it back, usually over a long time, like 15 or 30 years. Okay, so every single month, that payment you make is really split into two buckets. The first is what we call the principal. Think of that as you paying down the actual mountain of money you borrowed. The second bucket is interest, and that's basically the bank's fee for letting you borrow their money in the first place. Both get smushed together into one single monthly payment. All right, so to actually calculate this stuff, you only need 4 key things. Think of them like the ingredients for your mortgage recipe. And to make this super, super clear, we're going to use a running example as we go. First up, ingredient number 1, the price of the house. Easy. So let's say you've been searching, you find the perfect spot, and the price tag is $350,000. Got it. Next, we need your down payment. This is the pile of cash you bring to the table right at the start. For our example, let's say you've saved up 20%, which is 70 grand. Now, that 20% number is kind of the magic number. It's a big goal for a lot of people because it helps you dodge this annoying extra fee. We'll get to that in a sec. Okay, so your loan amount? Super simple math. It's just the home price minus your down payment. So in our story here, that's $350 minus 70, which leaves us with a loan of $280,000. And that is the principal we were just talking about. That's the amount we have to pay back. And our last ingredient is actually 2 things: the interest rate and the loan term. So for our example, let's just say you get a 7% interest rate on a 30-year fixed loan. Now, that word fixed is super important. It means that your core payment, the principal and interest part, is locked in. It's not going to change for 30 whole years. Okay, we've got our 4 ingredients. We're ready to cook. Now it's time for the big reveal, the aha moment. Now, there is a super complicated math formula for this, but let's be real. Nobody does that by hand. We all just use an online mortgage calculator. So you take our numbers, that $280,000 loan, at 7% for 30 years, you pop them into a calculator and boom, out comes your number. For just the principal and the interest, your payment is going to be about $1,863 a month. And you might look at that and think, okay, I can handle that. But wait a minute, is that everything? Is that the final number that's going to come out of your bank account every month? Spoilers, for almost everyone, the answer is a big, fat no. And here's why. The bank usually bundles a few other costs into that same monthly payment. You've got property taxes. Those are going to be different everywhere. You've got homeowners insurance, to protect the place from fire or whatever. And remember that annoying fee I mentioned earlier? If you put down less than that magic 20%, you also have to pay something called private mortgage insurance, or PMI. So once you tack on some estimates for taxes and insurance, suddenly your real monthly payment jumps up to something closer to $2,400. I mean, that is a massive difference, right? And knowing this is everything when it comes to figuring out what you can actually truly afford. But wait, there's another really cool kind of secret thing about that fixed payment. Even though the dollar amount you pay is the same every month, what's happening inside that payment, it changes, like a lot over the life of the loan. Check this out. On your very first payment, over $1,600 of it is just interest. That's just money for the bank. Only a tiny little sliver like $230 actually chips away at your loan. But then you fast forward 30 years to your very last payment, and it's completely flipped. It's almost all principal and just a tiny bit of interest. So what's the big takeaway here? It's huge, because so much of your money is just going to interest at the beginning. any extra cash you can throw at the principal in those first few years, it has a massive, outsized impact. We're talking about saving you tens of thousands of dollars in interest and paying your house off years earlier. It's a game changer. Okay, so that's our example. But now let's talk about you. How do you find your number? It's actually pretty simple, just 4 steps. Step 1, figure out your budget. A really common guideline is the 28% rule. Basically, try to keep your total housing cost under 28% of your income before taxes. Step 2, figure out your down payment. What can you realistically save up? 3, go online and check the current interest rates. They literally change every day. And finally, step 4, take all that info and plug it into an online mortgage calculator. Play with it. See what happens when you change the numbers. All right, before we wrap up, I've got a few final pro tips for you. This stuff goes beyond just the numbers, but it's super important for setting you up for success. First, get pre-approved before you even start browsing Zillow. Seriously, this tells you exactly what you can afford and makes you look like a serious buyer. Second, your credit score matters a lot. A great score means a lower interest rate, and that can save you thousands of dollars. And number 3, don't forget about closing costs. These are a bunch of one-time fees that can add up to another 2 to 5% of the home's price. You gotta have that cash ready. And look, if you take away only one thing, let it be this. A bank will tell you the absolute maximum amount of money they're willing to lend you. Please, please, do not think that's the amount you should borrow. The only number that matters is the one that lets you sleep at night, the one you are truly comfortable paying every single month, no matter what. See? Calculating your mortgage payment isn't some big, scary mystery. Once you understand these key pieces, you can walk into the whole home buying process feeling smart, feeling empowered, and ready to find a place that you don't just love, but that you can actually, truly, and confidently afford.